Welcome to the Deep Dive. Today we're tackling a really fascinating subject, how to actually make money in the stock market.
Yeah, and it's a big topic, right? But we're not talking about, those overnight riches schemes you see everywhere.
Exactly. No hype here. This is deeper. It's about a system, really, a philosophy grounded in, well, over a century of market history.
And painstaking analysis, looking at the biggest winning stocks over time, what made them tick.
Right. So think of this as getting like a serious edge, a blueprint for understanding how markets actually behave, finding patterns.
Patterns that have historically led to, pretty significant returns.
And for you, our listener, we know you've shown interest in getting up to speed quickly in areas like finance, investing.
Yeah, without getting totally bogged down. So this deck dive is really designed for that cutting through the noise.
We want to deliver those actionable insights, those aha moments, hopefully without it feeling overwhelming.
Clarity is the goal, making sense of it all.
Okay, so the foundation for this deep dive comes from the How to Make Money in Stocks trilogy. This isn't just theory, it's based on a massive historical study.
Over 125 years of data. I mean, that's a serious amount of history they sifted through.
Looking for the common threads, the characteristics of the market's biggest winners.
And our mission, really, is to pull out the key principles from all that research, the actionable strategies.
We're not trying to make you a day trader, glued to a screen 24/7.
No, definitely not. It's about equipping you with practical, common-sense tools to make smarter decisions.
To potentially get better returns over time without having to quit your day job.
Exactly. Just clear analysis, trying to keep the jargon to a minimum.
Okay, so let's get into it. The core framework we need to understand is called the CAN-SLIM system.
Right. CAN-SLIM. It's an acronym, obviously. 7 key characteristics they found again and again in those winning stocks before they took off.
CANSLIM. Each letter stands for something specific.
And it's interesting. This wasn't just like cooked up in a lab somewhere. The source mentions Investors Business Daily, IBD.
Oh yeah, IBD. They're central to this.
They actually had interactive workshops, even a home study program, teaching people how to use CAN-SLIM.
Practical application, workbooks, DVDs, showing how to spot these traits and use IBD's ratings.
Right, and one of the big findings, maybe one of the most important, was about this new factor.
The N in CAN-SLIM, right.
Exactly. The biggest winners often had something significantly new going on. A revolutionary product, maybe?
Or a service that just clicked.
Right.
Or even new management shaking things up.
Yeah, or they were just part of a whole industry group that was taking off because of some fundamental market shift.
So it connects to the bigger picture then. Innovation, progress.
It really does. The market reflects those economic shifts.
Right.
It's not just random tickers. It's about understanding growth drivers.
And they prove this by looking at the single best stock each year for over 125 years.
Yeah, and the specific examples they give really make these ideas concrete.
Okay, let's look at one. Bethlehem Steel. Back in 1914.
Yeah, 1914, World War I breaks out. Suddenly, Bethlehem Steel is producing something like 60% of the Allies' munitions.
Wow. So massive demand, huge earnings growth.
Exactly. And the fascinating part is the charts from back then, presented in the source, they actually show these buy points.
Like technical signals, even back then.
Yep. Breaking out at an 18-month base, they called it. Then a shorter 6-week high-tight flag pattern.
And places to add more shares, maybe.
Yeah, on pullbacks to the 10-week moving average line, it showed continued strength.
So what should you, the listener, take from that? It wasn't just a solid company.
Right. It was a company whose specific strength met a massive, unexpected global event. Huge demand.
And the chart patterns, the technicals, they lined up with that fundamental strength, signaled entry points.
Precisely. Then you have IBM in the 1920s, another great example.
They weren't just sitting still. They were expanding, innovating.
Developing new stuff, like those horizontal sorting machines. Game changers for data back then.
And again, the charts showed patterns.
Multiple buy points. A 36-week cup with long handles sounds technical, but it suggests big players accumulating shares.
Accumulating over time. What else?
Periods of tight closes for 3 weeks, a 7-week base, even this complex base-on-base-on-base thing.
Okay, so multiple consolidation periods before moving higher.
Exactly. And here's a key point they make.
Right.
Sometimes a stock drops suddenly a shakeout, but if it snaps back quickly above that 10-week line on higher volume,
that can be another chance to buy.
Often, yes. It shows resilience and renewed buying interest.
So IBM really shows that N for new products driving growth.
Definitely. And those multiple bases suggest sustained institutional buying didn't happen overnight.
Okay, jumping ahead. Late 1950s, Thiokol Chemical. Maybe not a household name now.
No, but back then they were cutting edge. New rocket fuels for missiles, big deal
The
technology.
Cold War era, right? So huge potential.
And the stock price reflected that. Big surge. And again, the charts.
Showed similar patterns.
Yep. A 53-week cup with handle, 4 weeks of tight closes, these ascending bases forming on pullbacks to the 10-week line.
Sounds like a trend. And you mentioned volume earlier.
Yeah, Theocal showed big volume spikes. That's often your clue that institutions, the big money, are buying heavily.
So right industry, right time, game-changing tech, institutional support. Powerful mix.
Absolutely. Then there was Zenith Radio, mid-50s, classic growth,
How much crowd?
up almost 500% in about a year and a half. Incredible run.
Wow. But did the charts also show when to get out?
Yes, that's the other side. They mention a climax top pattern, a sharp spike up on huge volume, then a reversal. That was a sell signal.
So recognizing the end of the run is just as important.
Crucial for locking in profits. Zenith also had a high tight flag pattern earlier in its run.
Got it. Okay, next. Universal Controls, late 50s.
Similar story in some ways. A 43-week cup with handle, then a 10-week flat base.
Yeah.
Patterns preceding big moves.
And the buy point identified.
A 4-week high tight flag. But, like Zenith, it also showed a sell signal later.
Another climax 10.
Yep, after the price doubled in just 6 weeks. That kind of parabolic move is often unsustainable.
So identifying good bases to buy is step one. But watching for signs of excess, like that rapid doubling, is key for selling.
Exactly. You need both entry and exit strategies.
Resorts International, 1978. What was their story?
They were in a hot sector hotels, gaming in the Bahamas, and their earnings were taking off.
So strong industry, strong fundamentals, and the chart.
Showed buy points on the breakout and again on a pullback to the 10-week line with rising volume. Buyers were still interested.
Sell signal.
Again, a climax top. But they add another subtle point here. Sometimes, if volume stays high but the price stops going up.
That can also be a warning, like the buying power is getting absorbed by selling.
Exactly. A sign that supply might be starting to overwhelm demand.
Okay, fast forward to the 90s. Cisco Systems, tech bubble forming.
Right. Cisco was a monster stock. Its chart showed multiple bases over time, pullbacks.
Any specific patterns mentioned?
A double bottom pattern was noted, which can sometimes signal a trend reversal after a decline.
So even giants consolidate and offer new entry points.
Yeah, their growth wasn't just one straight line up. It happened in stages, with base building along the way.
And Qualcomm, late 90s, early 2000s, cell phone tech leader.
Huge growth area. Their chart showed a really classic cup with handle. Apparently, it formed after a few earlier breakout attempts had failed.
So persistence pays off, even for chart patterns.
Sometimes, yeah. And the source points to buying opportunities off the 10-week moving average on volume and also an ascending base.
Identifying leadership in those transformative tech waves seems key.
Absolutely. Now, into the 2000s. Apple. Around 2004 onwards.
Ah, Apple. Everyone knows that story. Did its chart fit the historical patterns?
Amazingly, yes. The source highlights a cup with handle formation that looked very similar to those historical winners we just talked about.
And the result?
Well, the example given goes up to about 2009, showing a 1,400% increase in roughly 4 years. Just extraordinary.
It really shows these patterns aren't just ancient history. They still work.
Definitely relevant in modern markets, recognizing that early Apple base could have been life-changing.
How about First Solar? Around 2007.
Interesting case. Huge sales and earnings per share growth quarter after quarter, but
What?
the PE ratio, the price to earnings, was already really high, looked expensive by traditional measures.
So did the system say buy or avoid?
The strategy highlighted was to consider buying after a pullback to the 10-week moving average. Growth trumped valuation initially.
But with caution. Any sell advice?
Yeah. Suggested considering selling or trimming if it got too extended, like moving above a channel line or having a big price gap up. Also noted good support after some weak closes earlier.
So even with super growers, you still need risk management rules.
Mm-hmm.
Pay attention to the chart action.
Always. Okay, a couple more quick historical ones. Syntex, mid-60s.
What was their new thing?
The pill. Oral contraceptives.
Yes.
Revolutionary product.
Huge societal impact. And the stock.
Showed a high tight flag after a big initial run-up on strong volume. And the source notes, this pattern wasn't unique. Other winners had shown it before. Historical precedent.
So patterns repeat. Last one, Rollins.
Also mid-60s, another high-tight flag. What was interesting there was the volume dried up during the flag.
Meaning selling pressure eased off.
Exactly, like sellers disappeared. Then, when it started moving up again, volume picked back up. Buyers returned.
So volume analysis adds another layer to understanding the price action.
Definitely. Lack of selling is bullish. Resumption of buying confirms the move.
Okay, so pulling this together from all those examples, the C in Can Slim current quarterly earnings is huge.
Absolutely critical, and not just any earnings growth. The source is clear. Mediocre isn't good enough.
What kind of numbers are we talking?
Minimum 25% to 50% year-over-year growth. But the really big winners, they often show 100%, 200%, even 500% or more.
Just massive acceleration.
Yeah, and that acceleration is key. If both sales and earnings growth rates are picking up speed over the last, say, 3 quarters,
That's a really strong sign, a reason to hold on.
very positive sign, yes. But they warn you, make sure it's real growth.
What do you mean real?
Growth driven by higher sales, not just, slashing costs to temporarily boost the bottom line.
Like the waste management example they gave. Earnings look good, but sales weren't growing. Unsustainable.
Exactly. You need that top-line growth, that demand for the product or service.
Makes sense. And looking back at those really old winners, 1910 to 1950.
Same story. Significant quarterly earnings gains 40% to 400% before the big price moves happened.
So the earnings often lead the price. What about Priceline? More recent example.
Yeah, they showed how even starting with only 34% growth, the key was that it accelerated dramatically. 53%, 107%, 126% in the following quarter.
And the stock followed.
Big time. That acceleration was the signal.
So, takeaway. Focus on strong, accelerating earnings. It helps find the leaders, even in speculative markets. EPS growth is vital, though not the only factor.
Right. Which brings us back to the end, the significance of new.
We saw it in the examples. Theocal's Fuel, Syntex's Pill.
It's almost always there in the biggest winners. A new product, new service, new management, maybe new industry conditions. Something transformative.
It's like the story of American innovation, isn't it? Railroads, electricity, phones.
Autos, airplanes, radio, TV, computers, the internet. The source lists them all.
Yeah.
Each wave created huge investment opportunities.
And specific companies drove those waves. McDonald's and franchising.
Livet's Furniture with the warehouse store concept. Houston Oil and Gas finding a massive new field.
That new element is the engine.
And the source is optimistic this continues. New leaders, new innovations will keep emerging. That's the nature of a dynamic economy.
Okay, crucial shift now. The M in Can Slim, market direction.
Hugely important, because trying to make money consistently when the overall market is falling, it's just incredibly difficult, maybe impossible for most.
So how do you gauge the market's health?
You watch the major indexes daily, the Dow, the NASDAQ, the S&P 500. Focus on their price action and, crucially, the trading volume.
And when the market looks like it's topping out, what's the advice?
Sell. Raise cash. Protect your capital. It sounds simple, but it's vital.
Why so drastic?
Because when the tide goes out, most stocks go down. Even former leaders might take years to recover, if they ever do. Big declines are hard to come back from.
And they warn against bottom fishing, right? Buying stocks just because they've fallen hard.
Yes, strongly. Using Cisco in 2000 as an example, looked cheap after falling but kept falling much further. Don't argue with the market, respect the trend.
The math is brutal, too. Lose 33%, you need 50% just to get even.
Right. And they mentioned the 2007-2009 bear market S&P down 58%. You needed a 140% gain to recover that. Avoid the big loss in the first place.
So how do you spot a market top? Any warning signs?
They give the March 2000 top as an example. Key signs were the NASDAQ reversing sharply on huge volume.
So heavy selling pressure.
Exactly. Also, many leading stocks were showing those climax top patterns we discussed, and there was a big down day across the board on high volume.
A confluence of negative signals.
Yeah. And they suggest using IBDs, the big picture column, and market pulse analysis to help track this day to day.
Tools to help identify corrections and when to raise cash, like in 2008.
They also talk about distribution days. Days where the indexes close down on higher volume than the previous day. Too many of those in a short period is a warning sign.
But timing the exact top is tough.
Extremely tough. Different indexes might peak at different times. You might get misleading bounces. 1981, 2000 had examples of that.
So the advice is generally
stay mostly in cash once a top looks confirmed until a new uptrend clearly begins. Don't try to guess the exact bottom.
Okay, so how do you spot the bottom then? When is it safe to get back in?
Again, watch the daily charts of the major indexes. Price and volume are key.
And they have a specific signal for a new uptrend.
Yes, the follow-through day. This is critical. Usually occurs 4 to 7 days or more after the market hits a low.
What does that look like?
A strong up day, maybe 1.5% or more, gain on significantly higher volume than the day before. It confirms the rally attempt has power.
So not just any up day. Needs conviction, volume confirmation.
Exactly. Conversely, after a long bull run, if you see heavy volume, but the indexes aren't making much upward progress anymore.
Churning. That could be a sign of distribution, maybe a top forming.
Could be an early warning, yes. They briefly mention the advanced decline line, but say it's secondary to price and volume of the main indexes.
Don't get lost in too many indicators. Keep it focused.
Pretty much. Price and volume on the major averages tell you most of what you need to know about the overall trend.
Okay, this next one feels really important, maybe the most important rule. When to sell and cut losses.
Non-negotiable, according to the source. You absolutely must cut every loss short, no exception.
Why is that so hard for people? Emotion, hope.
All of that. Ego, attachment.
Yeah.
It feels bad to admit a mistake, but holding big losses is irrational. It ties up capital you could use elsewhere.
So the rule is,
Cut losses at 7% or 8% below your purchase price. Think of it as cheap insurance. Protect your capital above all else.
even if the stock turns around right after you sell.
Doesn't matter. You followed your rule, you limited the damage, you can always buy back later if it sets up properly again. Discipline over hope.
They quote some famous investors on this, right? Rothschild selling too soon.
Yeah, and Joe Kennedy saying only fools hold out for the absolute top. Gerald Loeb advised trimming positions as they get overvalued. Preserve capital.
Okay, so discipline on losses. What about taking profits?
The guideline they suggest is aiming for around a 20% gain.
Just 20%? What if it keeps going?
Well, they say, except perhaps for the truly powerful, exceptional stocks that keep showing leadership. But for most winners, taking a solid 20% gain is a good discipline.
What's the advantage of that?
It forces a decision. It makes you evaluate, is this stock still strong, or should I redeploy this capital into something with better potential now?
So it helps you constantly upgrade your portfolio. Sell weaker ones, add to stronger ones.
Exactly. It encourages actively managing your portfolio based on current strength.
Okay, related topic. Concentration versus diversification. What's the take here?
The argument made is that the best results often come from concentration owning fewer stocks, maybe 4 or 5, that you know really well and watch closely.
Rather than owning dozens or hundreds you barely track.
Right. They question if massive diversification really protected people in the 2000 or 2008 crashes. Did it just mean you owned lots of losers instead of a few?
And maybe owning too many makes it harder to react quickly when you do need to sell. False sense of security.
That's the concern raised, yes. Slower reaction time in a downturn.
All right, let's talk about avoiding common mistakes. What are some big ones?
First, big one. Don't buy cheap stocks, generally meaning under $10, maybe $15.
Why not? Bargains.
Usually cheap for a reason. Higher risk, often poor fundamentals, less institutional interest. Focus on quality stocks, maybe $20, $30 or higher, coming out of sound bases.
We already covered stubbornly holding losses, cut them at 7–8%. What else?
Avoid selling short in a bull market. It's fighting the main trend. Reserve shorting, if you do it at all, for confirmed bear markets, and even then, it's very risky.
Still need a stop loss on shorts.
Absolutely. Same 8% rule applies to cutting losses on short positions.
Options trading.
Highly speculative. The advice is, unless you're very experienced, stay away. Focus on managing risk with stocks first.
And Wall Street analysts follow their recommendations.
Be very skeptical, especially during bear markets. They cite analysts staying bullish on tech stocks way too long in 2000. Do your own research using the CAN SLIM rules.
Okay, let's circle back to charts. Their role is critical, isn't it?
Absolutely. Fundamentals tell you what to buy: good earnings, sales, new products. Charts help tell you when to buy.
And when to sell, too.
Yes, selling decisions are often heavily based on chart action breakdowns, climax tops, etc.
What are the main patterns to look for when buying?
The 3 most common and reliable, historically, are the cup with handle, the double bottom, and the flat base.
Can you briefly describe the cup with handle again?
Sure. It looks like its name. A U-shaped cup formation usually takes several weeks or months, followed by a smaller dip or drift downwards the handle. Volume often dries up in the handle.
And a breakout above the handle's high is the buy point.
Often, yes, ideally on increased volume. They also mention base on base, where a stock breaks out, runs up a bit, then forms another base pattern.
Like stair steps up. Are there warning signs within patterns?
Definitely. Too many down weeks on heavy volume within a base is bearish. Big gap downs on heavy volume, these suggest selling pressure.
And buying breakouts from later stage bases, more risky.
Generally, yes. A base forming after a stock has already had a huge run-up, like a third or fourth base, is more likely to fail than an earlier stage base breakout. Risk increases.
Makes sense. Now, using Investors Business Daily, IBD, seems central to this whole approach.
It really is presented as a key tool. We mentioned their workshops and study programs.
But the daily paper or website itself has features to help apply Can Slim.
Lots of them. Investors Corner with reader letters, the stock charts themselves often have buy-sell points annotated.
The industry group rankings focus on the top groups.
Yes, concentrate on stocks in the top 20 or so industry groups. Avoid the bottom 20. Stocks tend to move in groups.
What about the Smart Select ratings?
Those give you a quick snapshot of key fundamental and technical ratings for a stock. Very useful summary.
And other sections, to the point for news.
Trends and innovations for new ideas. How's the market? For daily index analysis, accumulation distribution ratings.
Lists like Stocks on the Move, the IBD 50.
Industry themes, sector leaders, stock spotlight charts, and of course, investors.com, the website. It's packed with data geared towards this method.
Okay, we also touched on institutional sponsorship implicitly. Big funds buying drives prices up.
Crucial element. Need that institutional demand. Look for those volume spikes above average. That's often the footprint of institutions buying.
And IBD's accumulation distribution rating helps track that.
Yes, it tries to measure if a stock is under accumulation, being bought by institutions, or distribution being sold.
And volume needs to be high enough for them to trade easily.
Right. They suggest an average daily volume of maybe 400,000 shares or more, so institutions can get in and out without moving the price too much themselves.
Relative strength, we mentioned that rating, 80 or higher.
Yep, part of the buying checklist. Shows the stock is already outperforming at least 80% of the market over the past year. You want leaders.
And new highs. Stocks making new price highs.
Tend to go higher. It sounds counterintuitive to buy high, but strength often begets more strength in leading stocks.
Okay, one more interesting idea. The cousin stock theory.
Yeah, this is clever. If an industry group is really hot, look beyond the obvious leaders. Who supplies them?
Like suppliers to Boeing or suppliers to RV companies.
Uh,
They might benefit too.
exactly. Monogram Industries supplying Boeing, Techstone supplying Fleetwood. Find those related plays that might also be riding the wave.
Finally, let's touch on investor psychology. Conventional wisdom is often wrong.
Very often, according to the source, don't pay too much attention to media experts or the crowd sentiment, especially at turning points.
And that bottom fishing we talked about. Institutions doing it can create false rallies.
Yeah, those initial bounces off a low can look convincing, but might just be temporary relief before heading lower again. Need that follow-through day confirmation.
It seems like most investors, pro or individual, get fooled by emotion at tops and bottoms.
Psychology is a huge factor. Fear and greed drive a lot of bad decisions.
Yeah.
Sticking to a proven system like Can Slim helps remove that emotion.
Okay, let's try to wrap this deep dive up. Key takeaways for you, the listener. What stands out?
I think it's the systematic approach. Can Slim isn't guesswork. It's about specific factors. Earnings, sales, the new thing, market direction.
And the absolute discipline on selling rules. Cutting losses short.
Right.
That 7-8% rule is hammered home.
Absolutely. Plus, using the historical example, seeing how these patterns played out time and again, and knowing there are tools like IBD designed to help you apply it.
So the core message is really, success is achievable, but it takes work. Study, discipline.
And learning from mistakes. Everyone makes them. The key is not making catastrophic ones by ignoring sell rules. Can Slim provides a framework to navigate the market more effectively.
It offers a way to potentially get significant returns over the long run.
That's the goal. It's a process, not a magic bullet.
All right, so on that note, maybe a final provocative thought for everyone listening. Think about those historical examples. Bethlehem Steel, IBM, Apple, Syntex.
All driven by something new, meeting a huge need, often with accelerating growth.
What companies or industries today seem to fit that mold? Where are the early signs of that kind of growth and innovation emerging right now?
And how can you start using the Can Slim principles, the chart analysis, the market direction awareness we talked about?
To potentially spot those future leaders early. It's
Yeah.
an ongoing quest, right? Constant learning and observation.
Exactly. The market's always evolving. Thanks for joining us for this deep dive.